There is a single idea taught in the first week of every corporate finance class in the world. Wall Street runs on it. Every billion-dollar company uses it to decide what to build and what to walk away from. And almost nobody outside that room ever has it explained in plain English. It is called the time value of money. And once you actually understand it, you start to see that the gap between the people who quietly get rich and the people who stay stuck is not luck, and it is not income. It is this one idea applied early on repeat. So let me explain it the way a company would, and then let me show you exactly what it is worth in real dollars. Here is the whole thing in one sentence. A dollar today is worth more than a dollar tomorrow, not because of inflation, though that is part of it. It is worth more because a dollar you hold today can be put to work today. It can earn a return between now and tomorrow. So the dollar in your hand is not just a dollar. It is a dollar plus everything it could become while you wait. That sounds almost too simple to matter. It is the most expensive idea most people never learn. Here is how the corporate world uses it. When a company is deciding whether to build a factory, it does not just add up the cash the factory will throw off over the next 20 years. It does something stranger. It takes every one of those future dollars and drags it backward into today. It asks, what is a dollar we will not see for 20 years actually worth to us right now? And the answer is always less. That process is called discounting. The rate they use to shrink the future is called the discount rate. Let me make that concrete because it is beautiful once you see it. Imagine someone promises to hand you $1 million, but not until 20 years from now. It is guaranteed. How much is that promise worth to you today? Most people would say $1 million. A company would say about $258,000. At a 7% return, $1 million arriving in 20 years is worth roughly $250,000 today. That is not pessimism. That is arithmetic. The other $740,000 is simply the return you gave up by having to wait. You have actually seen this number your whole life and never noticed. Every giant lottery jackpot. When you see a headline that says $1.5 billion, and then you read that the winner only took home about $877 million, people assume the government ate the difference. It did not. That gap is the time value of money, printed on a billboard. The $1.5 billion is 30 payments spread across 29 years. The lump sum is what all those future payments are worth today. It is the future, discounted back to now. So that is the trap that keeps ordinary people ordinary. They treat future money and present money as the same thing. They think, I will start investing later when I earn more, when things settle down. And what they do not feel, because it is invisible, is that they are not just delaying a decision. They are throwing away the single most powerful ingredient they will ever have. And it is one they cannot buy back at any price. That ingredient is time. Here is the secret the wealthy understand in their bones. The engine that builds real wealth is not picking the perfect stock. It is not a high salary. It is compounding, and compounding only works if you feed it one thing, which is years. The person who gives it the most years wins, almost regardless of anything else. Let me show you the math, because the math is the whole argument. Take $10,000. Just $10,000 invested once and left completely alone at a 7% return. That 7%, by the way, is the real, after inflation, long-run average return of the American stock market for nearly 100 years. So this is not a fantasy number. After 10 years, your $10,000 becomes about $19,600. It roughly doubled. After 20 years, $38,700. After 30 years, $76,000. And after 40 years, that single $10,000 deposit that you never added a cent to becomes about $150,000. You did nothing. Time did all of it. There is a shortcut for this that finance people use constantly, called the Rule of 72. Take the number 72, divide it by your return, and you get the number of years it takes your money to double. At 7%, 72 divided by 7 is about 10. Your money doubles every 10 years. At 10%, it doubles every 7. That is the entire engine in one line of mental math. And I have been deliberately conservative with that 7% because it is the return after inflation has taken its cut. The raw, headline return of the American stock market over the last 100 years is closer to 10% a year. So let me show you what a steady habit looks like at that number, just so you see the full shape of it. $500 a month at 10% for 40 years does not become $1.5 million. It becomes about $3 million. You contributed $240,000 of that. The market handed you the other $2.9 million. And a strange piece of that, worth knowing, is that roughly 40% of the stock market's total return over the long run does not come from prices going up at all. It comes from dividends being paid out and quietly reinvested, buying more shares, that then pay more dividends. Compounding stacked on top of compounding. If you want the least theoretical version of this idea, here it is. If you had put $10,000 into a simple fund tracking the American stock market at the start of 1980, and then done absolutely nothing, not checked it, not touched it, not panicked in any crash, that $10,000 would be worth over $210,000 today. You would have made no decisions. You would have shown no skill. You would have simply refused to interrupt time. That is the whole game. Now here is the part that should genuinely change how you act this week. It is the difference between starting now and starting later. Picture two people. Both invest $500 a month. Both earn 7%. Both stop at age 65. The only difference between them is when they start. The first person starts at 25. By 65, they have about $1,300,000. They put in $240,000 of their own money over those 40 years. The rest, more than $1 million, is pure growth. The second person is identical in every way, except they start at 35 instead of 25. Same $500 a month, same 7%, same finish line. They end with about $610,000, less than half. Sit with that. A 10-year delay did not cost them 10 years of contributions, which would be $60,000. It cost them $700,000. The 10 years they waited was worth more than every dollar the late starter contributed across their entire life. And it gets sharper. Suppose the first person invests from 25 to 35, just 10 years, and then stops forever. Never invests another dollar. $60,000 in total. And the second person invests from 35 all the way to 65, 30 full years, $180,000 in. The early starter, who put in a third of the money and quit 3 decades early, still finishes ahead. The one who started earlier and quit beats the one who started later and never stopped. That is how violent the advantage of time is. So here is a question I want you to actually sit with, and I would love your answer in the comments. If you could go back and give your 25-year-old self one financial instruction, would it be earn more, or would it be start now? Tell me below, because I think most people learn this exactly 1 decade too late. Let me put a number on that waiting, so it stops being abstract. Go back to the person starting at 25 with $500 a month. If they wait just one single year, start at 26 instead of 25, they end with about $94,000 less. 1 year, $94,000. If they wait 5 years, they lose over $400,000. The cost of waiting is not zero, and it is not small. It is the most expensive thing in personal finance, and it does not send you a bill. Now let me show you the other side of the same coin, the one nobody wants to hear. Doing nothing is not safe. Doing nothing is a decision, and it has a cost too. Say you have $100,000 and you keep it in a normal savings account earning 0.5%, feeling responsible. Meanwhile, inflation runs at its long-run average of about 3% a year. After 30 years, the account statement will say you have about $116,000. You will feel fine, but in terms of what that money can actually buy, it is worth about $48,000. You will have lost more than half of your money's real value by trying to keep it safe. Cash sitting still does not hold its value. It quietly bleeds it. And this is why the time value of money is not really a finance topic. It is a way of seeing. Once you understand it, you look at every dollar differently. A dollar spent is not just that dollar. It is everything that dollar could have become. That $5 coffee every day is not costing you $5. Invested over a career at 7%, that daily habit is worth somewhere between $180,000 and nearly $400,000. I am not telling you to never buy coffee. I am telling you to know the real price of things in future dollars. The way a company knows the real price of a factory. It changes how you see debt, which is just the time value of money running against you. When you carry a balance, you are the future dollars being discounted, and someone else is collecting the return. It changes how you see a raise, and whether you invest it or absorb it into a bigger lifestyle. It changes how you weigh a pension lump sum against monthly payments, because now you can do the same calculation a corporation would, and ask what those future checks are truly worth today. It even changes how you think about your own working years, which are really just a stream of future dollars you can either spend the moment they arrive or send into the future to compound on your behalf. This is genuinely the same tool the biggest companies on Earth use to decide their entire futures. When a corporation weighs building a new plant, it discounts every future dollar of profit back to today, adds it all up, subtracts what the plant costs to build, and if the number is positive, it builds. Finance people call that net present value. You do not need the jargon. You already have the instinct now. You are just running the numbers on your own life instead of a factory. Same math, smaller building. The wealthy did not get a different set of rules. They got the same math you just learned, and they started respecting it earlier. They treated time like the asset it is, because it is the one asset you genuinely cannot make more of. So here is where this lands. The perfect portfolio was never really the dream. Freedom was the dream. Choices were the dream. Waking up one day and knowing your money works harder than you do, that was the dream. And that dream has a price tag a lot closer to starting today with whatever you have than to being born rich or timing the market perfectly. The only thing standing between most people and real, quiet wealth was the belief that they needed a fortune or a genius stock pick to begin. They needed neither. They needed time and they needed to start. You don't need to be a genius. You never did. And now you know the math. If this changed how you think about one expensive thing you have been telling yourself you can't afford, there are a lot more of these, the real math behind the life you actually want. Subscribe and let's keep decoding it together.